Are you guys keeping myself honest and on target for value under 5 minutes? So, in this 5 minute segment, I'm going to cover a strategy in which we were able to convert $60,000 of pre tax IRA money into Roth IRA money without any tax consequences for our client. And this is exactly how the strategy played out. So, we have a client, they make about 120 to 150K in earned income, W-2 income, relatively low actually for most of our clients. And they're, in their mid 50s, they're going to retire in the next 5, 6, 7 years. They had purchased this asset. That question was asked, should we do a cost segregation study on this? And this is not a one size fits all answer. So we kind of went through our calculations and said, you could do a cost segregation study. It really doesn't result in much of a refund. So year one benefit, the reduction in the income is kind of wasted because it's like, why are we doing that? Like, what's the point of reducing your income? You don't have a whole lot of withholding. You can't really carry forward those losses because it just eats up all of the income in this year and there's none left for a carryover the following year. And so essentially on the surface, it didn't really make a lot of sense for them to do a cost segregation study. However, they are doing a ton of private money lending and would like to continue growing that area of their business because it's essentially passive and there's no limit on how much you can lend. Like, it's just mailbox money as long as you can manage your risk. And so we decided we're going to take this pre-tax IRA over here that had about 80,000 in it, and we were able to convert about 60,000 of that tax-free. Now the taxpayer could have essentially stopped there, but why would you leave 20K over there? So we just did a full conversion of 80,000 and they pretty much had a marginal tax rate of under 8%. It was crazy. So how did I do that? How did that strategy actually play out? So when you have a conversion event, now inadvertently don't want to convert, just, flippantly convert IRA into Roth because you're going to end up picking a lot of income and then really hurt at tax time. But in their case, it was a strategic decision. When you convert a pre-tax IRA into Roth, the $80,000 becomes taxable income in the year of conversion, which is why if you're part of the FIRE community or if you're new to it, you might have heard something called a conversion ladder. So in this case, we could have converted it over multiple years. It was just very favorable to do it in one tax year. And they picked up another $80,000 of income. So their income went from, let's say, 120 to 200,000, which would have, in normal circumstances, increased their effective tax rate. But in their case, we then created a loss, a non-passive loss, through the cost segregation study on this new asset. And the loss, the increase in income and the loss kind of offset each other. Their actual income on their tax return did not shift. So they were still in the same tax bracket, same effective tax rate. Their withholding covered, their taxable income on their tax return, and therefore they did not pay any taxes on the $80,000 of conversion of pre-tax IRA to Roth IRA. So I hope this was helpful. If this is something that you would like us to evaluate for your portfolio of retirement assets and real estate, reach out to me. We'd be happy to have a conversation and see if we can help.